If you've started investing in the last 6 months and decided to put your money into unprofitable companies with high multiples, you're probably getting negative returns like I have with my Sharesies account. All is not lost with my Sharesies account, because if I change my portfolio settings, we can actually see overall I am up because I was investing before this rough patch in the market. So in this video, let's go over some data to show where the value lies in the stock market currently, as it's been on a downtrend during this current environment of rising inflation. Now that the QE or tapering is underway, rising interest rates are due to happen soon. This has caused a big sell-off in growth stocks due to investors moving money to safer companies, usually investing into profitable, large cap stocks. As the name implies, growth stocks are mainly unprofitable companies who spend their resources into growing bigger and bigger. However, with rising interest rates, the ability to borrow money now gets more expensive, which means access to money is reduced. Therefore, growth companies will not grow as fast as first predicted. This then leads to guidance being reduced revenue, which then impacts the share price. In this video, we'll go over why this is important. While I'm not investing heavily into small caps at the moment, I will still add to my small positions in TTCF and HIM stock while the share price is low, hoping for long-term gains or at least get my money back from those companies. However, I don't see them going up in the short term. So over in the computer, it's important to know that the stock market has 3 major indices, especially in the US. So they are the S&P 500, the Dow Jones Industrial, and also the Nasdaq Composite. When the share price usually goes up, everyone's pretty happy, but when the share price goes down and there's nothing actually wrong with the company, it might not be anything to do with the company. It might be the fact that the total market itself is actually declining, and this is where it's a good start to having a look of what's happening. So now, according to this article, one other indices has been hit the hardest. This is an index I follow as it contains TTCF, Tattooed Chef, since it's a small cap company. That index is the Russell 2000. So just a quick summary of what the differences between the S&P 500 and the Russell 2000 is that the stock market index comprises of 2,000 small capitalization companies, compared to the S&P 500 where they're larger cap companies, usually above $2 billion. So having a look at the S&P 500 index of its last 1 year performance, we can see that it's up by 15.79%, and it has been slowly increasing through the year, even though we've had these downtrends through here. Now if we have a look at the Russell 2000 index, we can actually see that overall for the past year, it's been performing pretty bad. It's currently down by 10.34%, and we can just see it's been pretty much flatline, trying to go up, and then eventually now it's starting to go down. And one of the stocks that is in the Russell 2000 is Tattooed Chef, and you can see it's had a similar pattern where always it has been declining since. So that's pretty bad for me. But if you saw my other video, you would have seen that I actually sold out of the stock before it got really bad. Not because it was going down, but for fundamental reasons and the current marketplace. So another growth stock that I'm in, which is also in the Russell 2000, is HIM stock, and we can see that over the past year it's actually lost a significant amount, about 80%, but this also shows that as the index has gone down, the stock within its index here has also gone down as well. So when you're looking for undervalued companies, one of the first things you can look for is the PE ratios. Now the PE ratio is not the be all and end all of everything. There is a lot of metrics, but a PE ratio will give you a pretty much good indication of if the stock is overvalued or undervalued just by looking at this one metric. Obviously you have to do your full due diligence before you invest in a stock, but looking at a company's PE ratio and comparing it across other companies is a good place to start to see whether it is overvalued. And one of the free reports that I look for in the internet is this thing called the Yardeni Report, and he seems to bring out these every couple of months, and what he shows is the PE ratios of all the companies inside that index, and this is how he compares it and shows which index has cheap companies in it and which index has expensive companies in it, and publishes this report. I'll put the link in the description below if you want to have a look at it. We're going to go straight to the interesting page, which is page 5, and that's the forward PE of the Russell 2000 index. So this page here shows you the forward PE of the Russell 2000 in this figure here, and they've broken it down into what's in the Russell 2000, what's the growth stocks, and what's value stocks. And we can see that the value plays that I had in the index, it had quite a high PE of 37.2, and remember, value investors look for a PE of 10. So we can see here that they've all sort of gravitated after the hype has gone up. So this is in 2020, that the hype has gone up and it's slowly coming back down again because the stock price is pretty overvalued when it's up above this range here. So everyone's decided to take some profits, and we can now see the PE ratios coming back down and starting to really get back into value territory. It's still a little bit high, but again, they're now coming back down, and that's why we can see the sell-offs in those stocks. So the most important graph we're looking at here is the forward PE ratios for US small caps, and we can see from the red line that the Russell 2000 is at 22.3 PE. So that's right there at 22.3, and we can see that the S&P 600 small caps is at 13.5, which is down here. So these are the years, so 2022, 2021 and 2020, and we can see that it was very high in 2020. But if we look down here, we know that a good PE ratios to have in a company is 10. So a PE ratio of 10 means that it makes money and has positive earnings. So what this graph is telling us is that there is some opportunity in the S&P 600 where the PE ratios are now much lower than the previous years. So this is looking back 2022 now. This is looking back about 20 years, and it's showing us that historically that we are now paying a lot less for these companies previously that they've been. So the opposite would be picking up a company where it had a high PE ratio, which means there's a lot of risk because you're paying more for the share price, and the underlying earnings the company's making is actually a lot less than what we would be if we were paying around here for that company. Well, that is enough for me today. Thank you so much for watching. I hope you found value in understanding why it's important to track the greater indices to know how the stock market is going and know where to invest for long-term gains. Before you go, please help me out and hit that like button on the video. It helps to get these videos out to new people who might want to start investing, and feel free to subscribe to be closer to financial freedom. As always, safe investing, and make sure you do your own due diligence in the stocks that you buy, because I am not a financial advisor. Drop me a comment down below of your thoughts. The trading platform I use is Interactive Brokers, Hatch Invest, Stake and Sharesies for individual companies, and I use InvestNow for index funds. If you want to start investing, you can use any of my referral codes down below to start your own investing journey if you are from New Zealand. And if you want to know what I'm investing in 2022, just click this video at the end as I tell you all about it. With that said, I'll see you on the next video. Goodbye.